Imagine waking up one morning, opening your P2P lending account and realizing your money is stuck. Not because you made a bad decision on a loan or because a borrower defaulted overnight, but because the way P2P lending platforms are structured made your money far less accessible than you thought. This happens more often than you think. And that's exactly what we're going to cover today. Let's get into it. First, let's quickly cover what P2P lending actually is. P2P, or peer-to-peer lending, connects borrowers directly with investors through an online platform. Instead of a bank issuing the loan, individual investors provide the capital and earn interest as borrowers make repayments. Sounds simple enough, but there are several risks hiding beneath the surface. The first and most obvious is default risk. This is the risk that a borrower simply stops making payments. When that happens, investors may lose some or even all of their invested capital. This is the core risk of any lending business. After all, if people don't repay their loans, there's no interest to collect. Some platforms try to reduce this impact by offering something called buyback protection, where loans that become overdue are repurchased after a certain period. It can soften the impact of defaults, but it still depends on the platform being able to honor that promise. The second major risk is liquidity risk. Unlike a savings account, P2P investments are often locked up for a fixed period. If you suddenly need access to your money, you may not be able to withdraw it immediately. If liquidity is something you care about, one platform people look at is Lendamax. It's a crypto savings platform where you're not locked into fixed periods, so you can deposit and withdraw more freely while still earning yield that can reach up to around 25% APY, depending on market conditions. The third major risk is platform risk. Most investors spend a lot of time evaluating borrowers. But what about the platform itself? Remember, the platform is responsible for processing payments, matching lenders and borrowers, and managing the entire system. If the platform experiences financial difficulties, operational failures, or in extreme cases shuts down entirely, investors could face delays, losses, or uncertainty regarding their funds. In other words, even if the borrowers are paying, the platform itself can become the problem. And finally, there's regulatory risk. P2P lending exists within a constantly evolving legal environment. Governments can introduce new regulations, tax rules, or compliance requirements that affect how platforms operate. These changes can impact investor returns, platform profitability, and even the availability of certain investment opportunities. Now, does this mean you should avoid P2P lending altogether? Yes, absolutely. Just kidding. Many investors have earned attractive returns through P2P lending for years. The key is to go in with your eyes open and diversify where possible. Thanks for watching, and I'll see you in the next one.